If things are starting to feel pretty bad here at home, it might feel a little better taking a look across the pond. The EU is currently facing a number of pressures that are creating a big wall of worry. There's the Ukraine war, obviously. It has energy prices surging. Eurozone inflation is running hot, up more than 8%. Producer prices up more than 30% in some countries. And Europe's fear gauge, the spread between German and Italian bonds, it's been widening, with Italian yields hitting their highest level since Europe's sovereign debt crisis and leading to an emergency ECB meeting just last week. Joining us now, Fred Kemp is CEO of the Atlantic Council, and Peter Bookvar is Chief Investment Officer of Bleakley Advisory Group. Both are CNBC contributors. Welcome, guys. Fred, I thought it was interesting that you said the ECB's emergency or ad hoc meeting last week was really just about helping Italy. Why that country in particular?
Yeah, of course, some people thought it was about increasing rates, but that had already been cooked. Now, it was about helping Italy because you're in a situation where the credit spread has become so great. And at times of economic strength in Europe, the creditworthiness of differing European Union zone members gets papered over. At times of economic stress, the differences really reveal themselves. And you're seeing it reveal themselves, not just Italy, also Spain. And you're in a situation where the ECB has to make a decision whether to start helping Italy the way it did Greece a little while ago. But the Germans at that emergency meeting were not very much in favor of some of the market solutions, buying up Italian bonds, using Eurozone money to support the bond market in order to close this gap.
And Peter, are we going to be in the situation? So the thing that's, we're coming up on the 10-year anniversary of Draghi's whatever it takes comments, one of the most lauded, most significant central bank moments of the millennium so far. And he was able to pull that off at the time because there was very low inflation, and it was hard enough back then as it was. Now we have very high inflation. How does that box policymakers in if you think it does?
Extraordinarily difficult. So as you mentioned, 2012 was when he made that comment. That was in response to the 2011 and into 2012 spike in rates in those peripheral countries, where the Italian 10-year spread relative to the German 10-year Bund yield got over 500 basis points. So they went from an institution that was supposed to focus on price stability, then it shifted to lowering the bond yields on these peripheral countries, to then shifting back to wanting to generate inflation. And here we are trying to now contain out of control inflation, at the same time trying to keep Italian yields from rising further. I'm not sure how they thread this needle at all, but it does show you that the real number one priority of the ECB is first containing and financing the debts and deficits of these Eurozone countries.
Yeah.
And price stability is number two.
I totally agree. And yet that's why I thought it was so interesting that Goldman last night put out an analysis where they said they think of all the central banks, the ECB is least likely to stop hiking because it's the one that seems most focused on these inflationary pressures that they have. There's no let up in the energy price situation, Peter. So what's that going to mean?
Right. And we're talking about an institution that is still doing QE for another week. And even after a July rate hike is still going to have rates below zero. So I don't know how they're going to thread this. 2% is their give or take inflation target as well. I don't see how they get there without causing a further blowout in interest rates in all countries. I mean, Italy in particular, pre-COVID, their debt to GDP ratio was about 130%. Now it's 150%. So that's why they are uber sensitive to their yields blowing out relative to Germany.